Just a quick reminder that everything is for educational purposes only and is general in nature. American Express, we've adjusted once. We did a roll down and add. We're still sitting at a 15 delta. So that one, no action needed. If anything, you could potentially add a bear call spread on the upside. I'm just going to have a look at their charts. Some of the bank stocks have actually been looking okay, other than today's action. We're seeing pretty strong, the accumulation distribution line's holding up pretty well, but we are below a 50-day moving average, below that declining 21. So that's sort of an optional thing that you could do here, is to maybe add a bear call spread, which will help reduce our delta dollars. It will increase our premium, and it will just protect us a little bit more if the stock continues to go down. So we'll just have a look at what that would look like if we add sort of a standard 15 delta. Not getting a delta figure. Sometimes when you go to a new tab and then back, you'll get the delta. There we go. So the 15 delta was around about there. Yeah, there we go, 15 delta. And notice how the position changes. If we just do the one contract on the call side, cuts our delta dollars in half, doesn't add the full risk on the upside. Our T+0 line looks pretty good, and we've increased our premium received. We're going to get about $110 for adding this bear call spread, and that'll help us if the stock keeps dropping. That'll help us play defense on the puts, that extra premium that we're generating here, and it just cuts our delta risk as well. So I think that's not a bad adjustment here in this case. Again, with some of these positions, I don't want to be too aggressive adding on the untested side, because if the market does reverse, we're going to then come under pressure a little bit on the upside. So that's kind of optional. You don't have to do this. If you think the market's going to continue to be quite bearish, you want a bit more protection, you could certainly add that in. Microsoft, we've already adjusted once. So again, coming under pressure on the downside, we're going to need to do a similar adjustment here where we roll everything down, and we're going to roll out to April in this case. Our current expiration is March, getting into that sort of 2 to 3 weeks to expiration. When we're adjusting here, it's going to make more sense to roll out to April, buy ourselves a little bit more time for the trade to recover. We're only down maybe 200 on this one. It's not too bad so far, but again, we've blown through that 25 delta. Ideally, you want to adjust at a 25 delta, but if the market moves really quickly, you don't get to it in time, you can still salvage the trade. It just makes it a little bit harder. And we're starting to roll down that hill a little bit too much. But in this scenario, we've got about $430 in premium. So it's going to cost us $430 to buy this one back. We're going to roll out to April. Let me just check. Yeah, it was 3 contracts in the puts, 2 in the calls. So we're keeping our position size the same, buying ourselves an extra month for the trade to work out. Sorry, April. And you can see they're much, much better looking trade. We've got a much flatter T+0 line. We've significantly reduced our delta risk. We've still got good theta. It's cost us a little bit of money to make that adjustment. But again, no big deal. We're still positive premium overall. And we'll just wait for the market to calm down a little bit. If volatility drops, we're going to do really well. So yeah. All right, Amazon, 24 delta. I believe our price alert, yes, our price alert was 203. It did go off today. So I'd look to play a little bit of defense here. What I would look to do is buy back that spread and roll it down 5 points. We're not going to add any contracts this time. We're just going to keep position size the same, and we're going to add a call spread. So there's our new position, an unbalanced condor. So I'll just show you that adjustment again. This is our initial position. A bull put spread. It's going to cost us about $200 to buy that back. Delta dollars 2,200. So we close that out. This becomes our new bull put spread. And we're adding a bear call spread. Delta dollars has dropped from plus 2,200 to 850. And it hasn't cost us anything to make that adjustment. Our premium's still around $200, so the only thing it's cost us is our commissions. We've really flattened our T+0 line. We're nice and evenly spaced. Very happy with this adjusted position. Make sure to check out all the resources in the description below. I hope you enjoyed the video. Reach out anytime with questions, and have a great day.